Hello, my name is Daniel Sa, and I'm Assistant Branch Manager and Senior Mortgage Consultant with Residential Finance Corporation. Today we're going to talk about credit. Specifically, what is a credit score, how is your credit score calculated, and what credit score you need in order to qualify for a mortgage loan in today's mortgage industry. Let's start by telling you what is credit. Okay? A credit score is a number generated by a mathematical formula based on information on your credit report compared to the information of tens of millions of other people. The resulting number is a highly accurate prediction on how likely you are to pay your bills. Credit scores are used extensively, and if you've had a mortgage loan, a car loan, a credit card, or auto insurance, the rate you receive is directly related to your credit. People with the highest credit scores tend to receive the lowest interest rates. Now, let's talk about how your credit score is built and how it's calculated. Now, most people tend to believe that if they simply make their payments on time, they should have perfect credit. And that is actually incorrect. You can make your payments on time and still have a low credit score. Now, so let's break this down and find out how it's calculated. 35% of your credit scores come from the history of your payments. So if you make your payments on time, that accounts for 35% of your credit. So when you're making these payments, make sure you're making them on or before the due date. 30% of your credit scores come from the amounts that you owe on revolving debt. For example, if you owe more than 35% on a credit line on a credit card, that will impact your credit negatively. 15% of your credit scores come from the length of time of which you've had credit. So the longer you've had credit, the longer history that you have, the more points you'll score on this particular category. 10% of your credit scores come from the types of accounts that you have and mix of accounts. For example, if you have successfully maintained revolving or installment accounts in good standing, that accounts for 10% of your credit. The last 10% comes from new credit applications. So if you're out there shopping for credit cards, putting in tons of different credit card applications, that will impact your credit negatively, and you may lose up to 10% of your credit scores. Now, with that said, credit scores range between 350 to 850 points. The average credit score in America today is 675. An excellent credit score is considered to be 720 or above, and that'll typically get you the best interest rates. Now, in the mortgage industry today, in order for you to qualify for a mortgage loan, your credit score has to be at least 620 or above. So with a 620 credit score, you can still be approved for a mortgage loan. Okay? With that said, my advice to you is get to know your credit. Find out what's in your credit report. Review your credit at least once a year. You can do that by polling your credit. There are reliable sources out there that you can do that. You can use truecredit.com, which is owned by TransUnion. Now, they do charge you a fee for you to utilize their service, or you can get a free copy of your credit report annually by going to annualcreditreport.com. So my recommendation to you is get to know your credit, be very familiar with what your credit score is before you put in your mortgage application. That will ensure a smooth process on your mortgage application, as well as ensure that you get the absolute best interest rate with your mortgage loan. So thank you very much for watching us today, and I hope that this information is valuable to you in the future.